Video recording as well first. Okay. So this program has been done, I believe, a month ago. Then people requested me to do it again, so I'm doing it again. Uh, I will try my best to go from very basic. And assumption is the program is designed for guys who does not know anything about option trading, but they know probably something about the stock trading. So if you guys, some of you guys are expert in uh, option trading, or you know option trading, so at the beginning you may get bored, but I have to go from the basic to facilitate all others as well.
Hmm.
So uh, Adnan Mansoor, I think you are unmute, so we can hear background noise also. So program would be, we will be actually going through the session, and if you have any question, you can put on the chat box, and myself or brother Adnan would help me to read your question and we will respond. You don't need to actually wait till end of the program for your question. You can actually put your question anytime. There would be some steps, uh, some milestone between the program, and we can actually consider your question in between somewhere. So just for my introduction, I've been trading for around 10 years now, and this is my contact information. I have few YouTube channels, and I have 3 YouTube channels for specific reasons. I have one for general purpose with the stock trading and other stuff. You can always go and subscribe that channel. And then I have one channel for professional training, which related to project management, leadership, and personality developments. And I have a third channel which is more of like motivational, but most of these video will be in Urdu language. uh, but you can always subscribe any of these channels. I have Facebook also. You can like the page also. I will send you these links and information on your emails after this training program. So in this particular webinar, I split this into 2 portions because people requested me in the YouTube. I should actually have a smaller version of the videos rather than 2 hours video. So I would be splitting this whole program into 2 pieces, but for you guys, it would be a one go. So at the end of the program, you will learn what is the difference between the option trading and stock trading. You will learn the key terminologies belongs to option trading, and you will learn some key strategies for option tradings. Uh, since we will be more focused on the terminologies, action items related to option and option strategy, so we may not go in detail for the geeks of the option trading, which also play a very important part to identify which option and which action you should be taking. So this will be our objective towards the end of this program. So before we go further, I would like to show that in for the option trading, you need to have a provision for option trading through your uh, stock trading platform. Either it is a bank or it's a non-bank option trading platform like Questrade or some others like Webbo or Robinhood's. So you need to request them. You should have the option trading provision. Generally, the institutes, they don't provide the option trading provision with your basic trading account. So most of the time you have to request them that you need an option trading provision. So before you do anything on the option trading, you have to check your bank account and or your institute account for trading, and then you have to make sure that you have the option trading provision there. So what is the difference between the option trading and stock trading? In the stock trading, one person has the stock and other has the money. So he want to buy the stock and he want to sell. So in this, for example, Amy has some dollars amount. She's a buyer, but Trevor has some stocks and he want to sell the stocks. So let's consider the current price of the stock is $10. So Amy has to has to pay for 100 stocks. Amy has to pay $1,000, and then she will get the stocks, and Trevor will get the money. So this is the simple stock trading transaction. But what's the difference between the stock trading and the option? So to explain the option, what are the options? Options are just derivatives. So fundamentally, option can also be traded in the same way as stock being traded. So you can buy the option, you can sell the option anytime. There are a couple of differences which we will discuss. But what are the options and why people actually encourage to do the option trading? Let's take an example. I have a house of $900,000 and I have a buyer A. He want to buy a house in cash. So he will pay the cash to me, 900,000, and he will buy the house. Buyer B, he does not have the money in his pocket right now, but he is expecting that money will come, or you can say he want to see the market value first, market transitions. So he's taking some time, but he is committing. He's making a commitment. He's saying, okay, I can give you 5% non-refundable token money and I will buy the house after 6 months for $900,000. So in the commitment, the buyer B is saying, I'm paying you 5%, which is the $45,000. And by end of 6 months, which let's say 30th of June, buyer B will buy the house for $900,000, even the market of house goes below or goes higher. Because of this commitment, he is paying 45,000 non-refundable to get the commitment. So it means if buyer B in future does not buy the house, he has to leave 45,000 on the table and go. So that is his commitment value. So let's assume after a few months, before the 6 month ends, the housing market crashed by 20% because of any good reason. And you have seen this recently in last decade that housing market in some area crashed, in some area it's booming, but it can happen anytime, the bubble. So let's say housing market crashed by 20%. So buyer A, who bought the house for $900,000, he would have a loss of 20% at that time, which is $180,000 equivalent. This would be his loss if he has to sell the house in that time frame. On the other hand, buyer B, his loss would only be 45,000 because he can actually just step back. He can leave 45,000 on the table and he will not buy the house because housing market actually gone by 20% low, which means now this house worth of 720. So this house worth of 720 in that time frame. So why someone actually buying this for $900,000 while he can actually step back for 45,000 and he can still buy the house for 75 7 $120,000 plus the loss which he made. So his total loss is 42,000. But if you buy the house, then the loss would be around 180,000. Next scenario, if market goes up by 20% and now house value is 1.8 million. So the person who bought the house, he would gain a profit of 180,000 by that time frame if he has to sell the house. But the person who paid a token money for 45,000, he would still get the benefit of this because he can still buy the house for $900,000 because he made the commitment. He made a commitment that he would buy the house for 900,000 wherever market will go if he want to. So he has a right to buy the house. So in that time frame, if you buy the house for $900,000 and sell the house for 1.8 million, then instead he will be getting a profit of 180,000. So both guys are getting a profit of 180,000, but the investment for 180,000, the buyer A would invest $900,000. The buyer B would invest only $45,000. So his profit, buyer A's profit is 20% of his investment, but buyer B's profit would be around 400% of his investment. So this commitment in the stock market called option. So option means you bought the right to buy the stock at a certain price up to a certain date with paying a premium to someone. So this is called option trading. So if you go back to the same example with option trading, if you go back to the same example, now Trevor has the stock. The current price of the stock is $10. Amy has the money. Whoever has some security, something from where he can pay, he can always have an option to sell the commitments to someone, and someone will buy the commitment. So if Trevor has the stocks, so he can always sell the option to someone who can buy the option by paying a premium, which means that guy who is buying the option will have the right to purchase the stock at a certain price with a certain date. It's the same phenomena as we gave the example in the housing market. So let's assume in this scenario, Amy thinks that this stock will go higher. That's why she want to buy the stock commitment at $10. So if stock goes higher, let's say in $15, so she can actually buy stock at 10 and she can sell stock at a higher price at that current market. On the other hand, Trevor thinks that stock will go down. So Amy is bullish on the stock, but on the other hand, Trevor is bearish on the stock price for near future. So Amy can buy the option, which is the right to purchase in 30 days, let's say, because you have to have a date for option. Option is not an open trade for rest of your life. You have to have a date. You can buy option for 1 week to 3 years, anytime in between as well. So she agreed to pay a premium of $1 for her right to purchase at $10. So she will pay $100 to Trevor, and now she have the legal right to purchase the stocks at $10 by 30 days, within 30 days. So she has a right to purchase the stocks, but she is not bound to purchase the stock. She can always step back. Okay, I'm not buying. Whether stocks price are higher or lower, she has the right to purchase, but not the obligation to purchase. So she can always step back, either with the loss or with the option price profit. So she decided to buy the option for now, not the stock. So she has the option, and Trevor got that premium money, which Trevor can keep, and Trevor also has the stock for now. So in the bearish scenario, let's say the stock price goes to $5 from $10. So who is winning in this situation? Because she was thinking that stock price will go higher, and Trevor was thinking the stock price will go lower. So in this case, Trevor is the winner. So who wins? Who gains the more benefits? So when stock price goes to $5 from 10, the premium price, keep in mind, premium price is the price for the option, and the price of the option also changes when the stock price changes. So premium price at that time may become zero or maybe very less value. So Amy will lose the premium and back off. She may not buy the stock at that time at $10 because the current price of the stock is $5. Why one should buy the stock at $10 then? But she may lose $100. She will step back, and Trevor will keep the stock and the premium he got, both things. In scenario 2, bullish scenario, so stock price goes to 20 from 10. It means Amy is winner at that time. So premium price will also go up from $1 to $2. So at that time, Amy would have few options to choose from one. Amy can keep the profit from premium. So it means she can sell the option for $2. She bought the option for $1. She can sell the option for $2, and she can get $100 profit, and she can stay away from the stocks. Or she can buy the stock at $10 and she can sell the stock at $20 at that time. This is called to exercise your option. And Trevor may have to sell the stock at $10 but keep the premium. So whatever premium Trevor already got, he still can keep the premium, but he has the obligation to sell the stock if Amy want to buy it at that $10 price. So this is this is called the option trading. So one thing is important. Anyone can sell the option. First of all, you need to understand, generally people think they can buy the option, but keep in mind, someone is selling the option too. It means when you buy the option, someone is selling. Who can sell the option? Whoever who has either the security, means the stock. So the guy can sell the option against that stocks. And if he does not have the stock, but he has the money equivalent to that amount of the stocks, he still can sell the option, but he has to block his money for that. And third, if Amy has the option, she still can sell the option on top of option because, but the option price should be higher than the option she bought. So she has the option, it means she has a right to purchase the stock at 10. So she can sell the option for $20 of a stock price. So if stock goes to 20, so she can buy the stock and she can still sell to that guy because she would be obligatory to sell the stock to the other guy. So one can sell the option if he has the stocks, if he has the money, or if he has the option, purchased option. So if you have three of one, you can buy the stock. So any question on this one? So you can type your question on the chat box and we will respond to your questions accordingly. So this is the basic phenomena of option trading. So now we can, I think we have one question here. How to check premium price of the stock? Is the price constant on the given day or changes? No. Premium price is always linked with the stock, and whatever tool you are using for stock trading, whichever platform you are using for stock trading, either it is a bank or it's a brokerage platform, they have the stock price as well as they have a list of option price on each uh, strike price of the stock. For example, the current stock price is let's say $20, $10. So he may have, you can see the option price for $10. You can see the option prices for $11 of the stock, when you can see the option price for $9 of the stock. So you will have the list of the option price at that time, which is also changing in every seconds. So it also depends on demand and supply. If more people are buying the option for the same strike price, the option price, the premium, if I'm saying option price, which means premium. So premium will go up. So if more seller is there for those options and less buyer, then option price may drop. So yes, option premium prices always changes. Next question I have, if you have bought option and you sell it to someone, then can you buy the stock still, or you have sold it already, so you are out? No, you are not out. You can by that time, because you have to have a date. By that time, if stock price go in your direction, then you can still buy the stock at lower price. In this particular example, you can still buy the stock at $10, and you must have sold the stock option above the $10 price. But it would be worthless if you are selling the option for $8 strike price. So you are buying a stock, which means you are committing that you will buy the stock at $10 and you will sell the stock to someone at $8. So that trade doesn't make any sense. But yes, if you actually sell the option on the option, then it means you are saying that should be higher price. So it means you may be buying a stock at $10 and you may be able to sell the stock at $15. So that would make sense. So if you are actually selling option for a lower strike price than you actually committed to other, then it will not work. So you are actually made a lost trade. So I believe I answered your question. Okay, so if we move back to types of these stocks and key elements related to stock. So in the option trading, first of all, when you buy the stock, you buy the stock 90, 50, 100, 1000, 5000, 10,000. You can buy any number of stock without any limit. But for the option, you can only buy contracts. In the option, term is called contract. One contract means $100. So why it says contract? Because this is an agreement between two bodies. That's what we were discussing. This is an agreement between two bodies that someone will be selling the stock to someone at a certain price, and other has the obligation, other has a right to buy the stock at a certain price. So each contract in the option trading is $100. So multiple of $100. So you can buy 10 contracts. 10 contract means 1,000 stocks you're talking about. So option being traded by contracts, not number of stocks, but as a multiple of 100. Then there are two types of options. So before we go to types of option, so whatever the current price of, let's assume there is a current price of a stock is 2.1. So what other terms play key role in option trading? There is an expiration date of your contract. So whenever there is a contract, there is an expiration date for that contract as well. So it cannot be an open-ended contract. So that is the risk in the option trading. So you can lose all your money by end of that date. Otherwise, if I have a stock, I bought 10,000 stock or 1,000 stock for $10 worth of stock. So I spent $10,000. So stock goes to $2. I lost 80% of my amount, but I can keep that stock for rest of my life until unless the company is not bankrupted. So I can keep that stock for rest of my life, and I can wait until it goes back to $10. So nobody can stop me. On the other hand, option trading, if I bought an option, I have a contract date as well. So if I spend $1,000 to buy some options, and by a certain date, either I will get a profit of $1,000 or that $1,000 can be zero value. So you cannot hold option for rest of your life. There is a certain date. So before that date, you have to take any action. Either you sell the option back, or you sell the option at a lower price, or you just let it expire, or you actually do some other strategies, which few strategies we will be discussing today. So expiration date is very important. Generally, in the Toronto and New York Stock Exchange and other worlds, the Friday generally is the expiration date. Either it's a weekly or a monthly contracts, but generally Friday is the expiration date. Even if you go a monthly contract, for example, you are taking 3 month time. So even at the end of the third month, that would be a Friday. Generally, this is the norm. So 2.1 is the current price. There is a term called strike price. And there are two options which people can do. One is called call option. Call option when a buyer is bullish on the stock. I repeat, when buyer of the option is bullish on the stock, not the seller of the option. So in our previous example, if I go back, so Trevor was bearish. He was thinking that stock will go down. But Amy was a buyer of option. She was thinking that stock will go up. So buyer would be bullish. Then you can buy the call option. This is called call. So whichever price you can pick, although current price of the stock is $2.1, but you can make your commitment on $2.2, $2, $1.1, $1, or $3. You can pick any cost, any price of the stock. Even that is not price there. The price is still not there, but you can make your contract on any chosen price. That price is called strike price. Strike price when contract strikes the wall. You made a contract, you pick a price. The price you pick is called the strike price. So if your chosen price, which is the strike price, is below the current price for call option, keep in mind, I'm talking about call option when you are bullish on the stocks, when you are thinking the stock will go up and you don't want to spend too much money on the stock, you can buy the option and you can still get benefit of stock right to upside. So if you are picking a price lower than the strike price, then it is called in the money strike price. So generally, if you are in the money strike price for call option, then the premium would be higher. If you go out of the money, which means current price of the stock is 2.1 and it does not reach to 2.4 yet, but you are expecting it will go to 3 or 4. So you are out of the money. So first it has to reach to your strike price, then it will go above. So this is called out of the money strike price. So you are free to pick any strike price, and all the brokerage platform, they provide you the list of price with all the strike price available for that stock. And keep in mind, not all the stock have the option provision. Few stock may not have the option provision, but majority does. So this is the call option. The next of this is called the put option. Now you can buy the stock, buy the option, even you're thinking the stock will go down. So you can still buy the option. So in this case, if stock price will go down, it will give you benefit. So in the call option, if stock price goes up, then you will get the benefit. In the put option, if stock price goes down, then you get the option. So if stock price goes in the direction which you are predicting, then you will be making money. So if you are bullish, you will buy the call, and if stock goes up, you will get the benefit, you will get the profit. If you are bearish, you buy the put, and if stock price goes down, you will get the benefit of that. So again, so put option. So stock price, if in this case, if I buy the strike price option for a strike price of 2.2, the current price is 2.1, then I'm out of the money. Sorry, I'm in the money. In the money, why? Because stock is already below 2.2 currently. So I'm in the money in this case. And when I will go strike price with 1.8, then I'm out of money. Why out of money? Because 2.1 still has to touch 1.8, and has to go below. So this is called out of the money if I'm bearish, and this is called in the money if I'm bearish in this case. So if I combine both, so you will see the in the money and out of money targets will be different for call and put option. So this is if in the call option, the higher price than the current price would be out of the money. On the other hand, for the put option, lower price than the current price would be out of the money. So this is the basic terminologies for option trading. Let me see. I believe I have few questions. How to calculate risk and reward, one contract. Calculation of risk and reward, there is no straight formula. But if you are planning, the risk is if you are buying an option and you are spending $500 in the premium, so your all risk for that option is $500. You can lose $500 at the expiry date, and your profit can be unlimited if stock goes in the direction you actually picked, put or call option, and it can go, it can skyrocket in that direction. Your 500 can be multiplied by 10, can be multiplied by 2, can be multiplied by 50. So you have to calculate your own risk, but whatever you are putting in the option premium, that is the major risk you have. So for example, if I buy 1,000 stock worth of $10, so I'm spending $10,000. So if stock goes to 20, I would be losing $8,000. At the same time, if I buy the stock option for a strike price of 10 at that time, and I spend only $100, a stock price, if stock price goes to 20 or 30, I may be multiplying my premium. But if stock price goes below 10, maybe $2 in that case, then I would be losing only $100 premium which I paid. That's it. So this is the calculation. Now everyone can calculate his own risk and reward. Another question I have, why would a bullish trader pick a lower strike price? So you're saying why would a bullish trader will pick, because if you're talking about in the money, in the bullish case, you're saying why someone will buy the premium or option at a lower price, because the option price would be changing more positive on that side. If from current price it goes to uh, like only 2% up, so your premium will be multiplying with that, so you will have more premium profit if you are in the money, but you have to pay upfront higher premium. So if you want to spend this is also related to your risk and reward. If you want to take lower risk, you want to spend less money in the option, you can always pick out of the money strike price. So that premium will always be lower, and definitely your premium changes will not be as fast as in the money. So that's why people pick where to strike. Will you be showing a trading platform on how it shows up on trading site? That would be challenging for me because we will be actually publishing this on the YouTube, so I may not be able to share the trading platform or bank, but I have some screenshot I will show definitely. I have some screenshots. Next question I have, in put scenario, if it does not touch 2.2, okay, become bearish at 2.15, is your trade active or does it need to touch? Your trade is always active. So whatever premium you have paid, you can always actually, your changes on the premium based on the price you have paid. So if you are paying from the higher side and it does not touch that one, that's okay. But it is all your premium will be changing much faster or slower. So it depends on some factors which are called geeks for option trading. I would be touching them very slightly today, but geeks you can always actually Google and you can find more details about those, but I will be giving a brief introduction of the geeks today. So I believe these were the questions I have for the for regarding these definitions. Now let's discuss some more details on the typical trade. So in the typical trade for call option, so keep in mind, whenever I say call option, it means you are the option buyer and you are thinking that stock will be bullish. So stock price will go higher. That is the basic fundamental behind the call option. So let's assume in this example, I have put some dates on the horizontal axis. I have put left side axis, y axis is stock price, and right side y axis is the option price, which is the premium price. So for this example to understand, I made them very straight numbers, which is not practical, because in the option premium price, lot of other factors like their theta, beta, these are the geeks. They play the role. But to make the example simple, to understand the basics, I put them straight. Okay. I said, okay, if stock price is $2, then the premium is 0.2 right now. For $3, the premium is 0.3, for 4, 0.4. So I just actually made it 10% of the price, just for understanding purpose. So let's assume the current price of the stock is 5, and the same would be your strike price. So for the understanding of this phenomena, I'm picking the same strike price. You can always actually pick the strike price of 6, the strike price of 4. It doesn't matter. It's only actually the changes in the premium. You pick this, you pick the price on the basis of the premium which you can afford. That's related to your risk and reward option. So I'm just picking for the example to understand, I'm just picking the same current price and strike price, and option price for this trade is 0.5. And we are talking about, this is called at the money. So we talk about out of money, in the money. If I'm buying the option at the same strike price, which is the current price, then it is called at the money. So we are talking about the call option. Let's say you are bullish and you want to buy a call, and I'm bearish and I have the stock and I'm selling you an option call. You're buying the call, I'm selling you the call because I have the stock. So if you bought the stock option at 0.5 and stock goes like this, and then at the expiration date, stock goes to $9. Who is the winner? Definitely you are bullish, you are winner, I will lose. So I will lose that, but I will not lose the stock until unless you buy my stock. So you still have the option. At the current price at 9, your strike price was 5. Now your option price is 0.9. So you bought option for 0.9 per stock or 0.5 per stock. And right now, at the expiration date, your option price is 0.9. So your money is already doubled. So you spend 0.5 per stock. Let's say you have 100 stocks, so you spend $50, and now the worth of those options are $90. So you already made $40 on the investment of 50. So now you have the same options as I have discussed in the example of Amy and Trevor, that you can sell the stock, sell the option at zero point 0.9 and make your profit. And even if you don't take any action, bank will not exercise anything, and you can keep, option will be expired on next day, and you will have your profit in your bank account. So you don't need to take any action. But you have the option to, you can buy the stock from me for $5. Even the current price of the stock is $9. I'm obligatory to sell you stock at $5. So you will buy the stock at $5 and you can sell the stock at $9. So if you bought one contract, which is the about 100 stocks, so you can buy the stock and you can pay me $500, and you can get the stock and you can sell the stock at $900, and you can keep the $400 profit. At the same time, you still have the premium. Keep in mind, the premium will not go anywhere. Whatever premium you have paid, I'll keep that one. Whatever the premium profit you have, you will still have that profit. Plus, you can still buy the stock and sell at a higher price. So this is one scenario. Other scenario, if stock goes from $5 to $3, so now I'm the winner. So I was thinking that stock is bearish and it went bearish. So now you can still buy the stock. You still have the right. You can still buy the stock at $5. But why will you buy it? Because current price of the stock is $3. Why would someone buy the stock at a higher price? You can always buy stock from market at that time. But your option price may be like 0.3 or maybe 0 at that time. So you may lose your option investment which you have made, which is $100, or you can sell the option at a lower premium, and you can reduce your loss if there is any option. Generally, at the strike price or expiration date, the option price worth 0 at that time. So before this, you can pick, you can decide that you can actually reduce your losses and you can sell the option to someone again. And now don't ask me why someone will buy from you. There are always few guys which thinks in opposite direction you think. So you are thinking at this time that stock is going down, but someone may be thinking that stock will just actually do skyrocket from this time and go up. So you can always find buyers, but lower chances to find buyer at that time. So it will actually go towards 0 at that time. So let me see, I have few more questions here. So option price is 0.5 means premium, yes. And then the that main thing here, how do we predict bearish or bullish or future price? That is the stock analysis. So I won't recommend anyone to do option trading until unless he is good or he has some mentor who can do the analysis for him, for the stock, in which direction stock will be going. But it is still the prediction and forecast based on the analysis or fundamentals. If you can do that, then you can decide which direction you should go for option. Then I won't recommend anyone who does not know how to do the stock trading analysis to do the option. So be careful on that. Otherwise, you will be losing your whole money. So this webinar is not to encourage you guys to do the option trading, but if you understand the stock and their analysis, then yes, you can make more money on the option trading. Are you saying that the buying, selling stock, I will make 400 profit plus the premium? Yes, I'm saying that whatever premium you make, you will still enjoy that benefit, but you still have the option to buy the stock and sell at a higher. The premium is separate from your stock price. So premium, whatever you have made, that's your premium profit, but you can still do the stock trading as well if you want to. Okay, so this is the call option example. Now we can do the same example for the put option. So if in this case we are doing the same trade at the money expiration date, you are bearish. You are thinking the stock will go down, and I'm bullish. So I'm selling you the put options. So from that price, with the same example, but in this case, you see the option price is in reverse. If I go back to the call option, you see the option price is increasing as the price increases. But in the put option, the option price will increase when price is reducing. So lowest option price is 0.2 for put. And when you go down, it's increasing because this is put option price. So in the stock trading, you will have the both on left and right side in your stockbroker website, that this is the call option price, this is the put option price. So you will notice that put option price will be increasing as the strike price go lower, but on the other hand, the call option price will be increasing if with the strike price goes higher. So this is just a reverse of the call or of the call option. So in this scenario, the current price is 5, strike price is the same because we are talking about at the money example, and option price is 0.8. So you paid premium of 0.8 per stock. So I'm bullish. So if a stock goes up to $10, so your premium would be reduced to 0 or maybe very lowest premium by the strike price. So you will lose your premium and you will step back. On the other hand, if a stock goes to low at $2 from the strike price of 5, your premium may go up from 0.8 to like 1.1 or 1.2, whatever will be variation, and you still have the right to buy the stock at $2. Oh, sorry, $5. So in the option trading, in the put option, that is the scenario. So you can lose your money if stock price goes higher, and you can make your money if stock price goes down. So again, I have few questions. Do I have to pay the premium in advance? Yes. Premium is like you're buying the option. Option is just being traded as a stock, but fundamentals are different. But trading is same. So you're buying the option, you're paying the money. You're paying your premium to someone. In which scenario I have to buy the shares or sell the shares? In both cases, you are buying the put or call. You have the right to purchase the shares at certain price. In the call option, if I go back to the call option, you have a right to purchase the stock at $5, even if it goes higher. But in the options, in the put option, you have the right to purchase the stock at a lower price, and you can sell at a higher. Okay. Do I have to pay the premium in advance if buying? Yes. I told you yes. Okay. That is what Adnan Mansoor responded. Thank you, Adnan. So in a call option, it is better to buy the stock on the expiration date, or is it better to buy the stock and sell it? I'm not sure exactly what you're saying, but I think call option, is it better to buy the stock on the expiration date? This is what you can do. You can always actually buy the stock at expiration date or just before the expiration date. But you have to calculate how much money you will be investing, and you need to make sure that through the stock analysis in which direction stock will be heading to. So this is call and put options, and this is just a pictorial and one table time frame. The strike price versus the call prices and the strike and put option prices and how it is changing at the uh, price. So I think we have done this example in the charts. So now we can discuss the option trading actions. This is also important. If you now you know that you can buy the call option, you can sell the call option, you can buy the put option, you can sell the put option, like the simple trades. But there is some differences. There is some differences from the stock trading and the option trading when you are taking the action. In the stock trading, you have only two actions. Either you buy the stock, you sell the stock. That's it. But for the option trading, you have few more actions. So if in the option trading, you can do the call option, you can do the put option. And when you are bearish, you can do the put option. When you are bullish, you can do the call option. In the put option, you have two actions to start your trade. If you are bearish on the stock, you can buy to open. This is called in your platform, in your stock trading platform, either from bank or from other. This is the terminology is being used. You are saying buy to open. So it means you are buying the option. You are paying the premium. At the same time, if you have the stock, you can or you have the money, you can sell the option. So when you are selling the put option, if you recall my example, when you were if I go here back in the option, you are buying the option because you are bearish. I'm selling the option because I'm bullish. I don't think stock will go down, but you are thinking stock will go down. So same phenomena. It means if you have the money, you can also, and you are bullish, you can also sell the puts option. So if I go in that direction and coming back to the same thing, so you can sell the put option if you are bullish and you have the money or you have the stock. At the same time, someone or you can buy the option if you are bearish, buy the put option if you are bearish. Now for the call option, you again have two. You can sell to open. You can sell your calls if you have the stock, if you have the money, one of these. So you can sell the call. When you are selling the call, you say sell to open. This is the action in your trading platform. But if you're buying the call, you say buy to open. You see, buy to open for puts, buy to open for calls, sell to open for puts, sell to open for call. So these are the actions you can take from your platform. So this is a start of your trade. You're opening your trade. So at the same time, towards the end of towards the expiration date, you can take any of the action to close your trend, to close your trade. So if you have sold the output option, you can buy to close. If you are in profit, you don't need to take any action. if you are in profit in any of these open trade, you don't need to take any action. Option will be expired with your profit in your bank account. You don't need to take any action generally. But before the expiration date, or you want to take any action, you want to quit the trade, and you're thinking that it will go in the opposite direction when you started the trade, so you can take the action and close your option trade. So if you have sold the put option, you can buy to close. If you bought the put option, you can sell to close. Same thing with the calls. So this is closing of your trade, end of your trade. So these are the actions generally you can find in your trading platform. There are two more actions, covered and uncovered. When you're selling you have covered and uncovered option as well. So covered option, it will say in your platform, sell to open covered. When it say covered, it means you have the money or you have the stock. It means it is covered. It is covered with your stock. And other action you will find in your platform is called sell to open uncovered. When it say uncovered, it means you don't have the stock, but you have the money. So bank will use that money to trade stock if they need to at the time of expiration. So bank will block that much amount of money from your account, and you will not be able to trade. You will not be able to use that money for any other trade when you sell something with uncovered. So these two terms will be additional in your platforms if you see for option trading. So this is there are some screenshots I'm having here. When you have to buy to open calls, this is the trading platform from TD Bank, TD Investment. So this is, for example, Apple stock. You will have the option chain option here. If you click, it will show you the call option and put option prices with the strike price list. So currently, if you actually open buy to open call and you pick the expiry date from here, you pick the strike price, and you can select what you want to buy. But you want to buy call, you want to buy the put. So, and this is a screenshot. We are doing the call option, and this is the premium you have to pay to buy the call. So stock price is 116 at some level, and your premium right now, the current premium is around 4.15, or it may actually change with the trade. So you are saying buy to open, and this quantity means the number of contracts. And then rest of the things are still same. You can the price type is, you can do in the market, you can pick the limit, and then you can pick the date of this trade until unless the trade is valid for you. So this is the screenshot for the call option. Then you have sell to open, sell to close. So this is the closing task. If you already have bought some option, so this is a closing trade option for you. You can sell to close at a higher price, maybe. For example, in the previous screen, when you bought at 4.15, you can sell now at 4.118. And to do this trade, you don't need to wait for the expiration date. You can do any time in between. Whenever you feel that much profit is enough for you, you don't want to take more risk to lose your money, you can sell your option back. And this is the quantity, which is 1 means 100. So I have a couple of questions. Let me see what questions you have. If the picking strike price hit before expiration date, of contract, it will automatically sell the contract? No, no. Uh, if you're saying strike price has nothing to do with your limit. So I believe you are mixing the strike price with the limit price for your trade. So there will be nothing happen automatically. You have to make the trade. You have to do the trade, sell to close. But if you are making profit, then if you don't take any action, the option will be expired with the same profit you have at that time. So trade will not be done. So there will be no automatic trade for that. Can we do the option trading in the registered? I'm not sure about that. I don't believe we can do the option trading for TFSA and RRSP, but you should check with your bank institutes. Uncovered calls are not allowed in registered. And okay, so someone is responding to your question. Can you sell to close beyond your expiry date? Beyond means after expiry? No. Once expiry date hits, you're done. So your contract will be expired. So nobody can take action on that after that. So that will disappear from your list already. So either you was in profit or in loss. So you at expiry date, you will incur that loss or profit at that date. So you will that trade will be expired and it will gone from your list of actions. We can't do option trading with these account. Okay, so someone is responding this. Okay, so buy to open. Then the next option I have is sell to close, the put option. So if you already bought some puts, then this is the time when you can sell your put option as well. So you see the put option price is higher. So that is always changing. Sell to covered calls. You can sell the covered calls if you hold 100 or multiple of stocks, or you have the options. You bought the option, then you can sell the covered calls on that. If price move higher, then you will get the benefit. So you can always sell the covered calls, and this is the screenshot of covered calls from the same TD bank. So when you are selling a covered calls, it means you have the 100 or multiple of stocks of Apple in your account already. So if, for example, you bought the Apple at 115, or you have bought at 116, this is the current price, and you are saying that by end of 30th October or whatever, so you can pick the date, and you're saying that you would be able to sell your stock at $118, and this would be your covered call. Covered call, generally you sell the covered call at a higher price than you bought the stock. So you keep the premium. So you have the under stocks at let's say $110. You sell the covered call at price of 18, premium of $4 stock. So you will get the $400 upfront as a premium, which you can keep at any cost. At the expiry date, if stock goes to $111, then you can $110, $111, then you can still keep the premium and you can still keep the stocks because it does not hit the strike price. But if stock goes higher than the 118, then you can someone or if I bought the your call, then I can buy your stocks at 118. You have to sell the stock 118. Now think, why someone will buy your stock at 118 when he's thinking the stock price will go to 130 or 120. So let's say even if stock price goes to 130 at the time of expiration, so you will still be selling the stock for $118. So the other guy will be taking profit from 118 to 130, but you will not, because you make the commitment, you sell the covered call for 118. So you have to sell the stock for 118, or you buy back the calls with a loss. So you bought, you sold the call for $400, you keep $100, $400 profit. But at the time when stock price is 130 and near the expiry date, now you have two options. Either you sell your stock for 118, or you can buy back the covered calls and you pay back 400 plus whatever the premium at that time. So you may end up paying $2,000 or $3,000 to buy back the calls, and you keep the stocks. So that would again your decision, your risk and reward option. So the question I have, we can't do the option trading. Some institute like TD allows option with the limited option. Okay, someone is responding. Okay, none with limitation, no uncovered calls. For this particular example, you invested this and made $1,200. Yes. Can you explain the difference between the regular calls and covered calls? What is the risk and benefit of each? So when you buy the calls, so you invest only the premium and you can lose only the premium. But when you are saying covered calls, so either you have to have the stock in your bank account or you have to have the money. So benefit is if a stock does go to 120 or 119, you still already got $4 premium, which is already you have it. And now you are selling the stock for 118, you bought for 110. So you still have $8 profit on the stock. You still have the premium of $4 per stock. So it means your total profit becomes 8 plus 4, $12 premium. And the stock price is 120. So someone can buy the stock at 120. You have to sell, but you have to sell at 118, and somebody can buy it 118 and sell it for 120. That's his call. But you will be getting profit of $12 per stock. On the other hand, the risk is if a stock goes to 130, 135, which is the current Apple price right now. So you would be losing the additional profit from the stock. So if you have bought at 110, you're selling at 118, but current stock price is 135. So you are losing the profit of $17. The other guy will be making that profit. And if you don't have the stock for the covered calls, then bank will lock your money and you will be losing same amount of profit, the difference of the current price and the other stock price. So next level is sell the covered puts. That is very risky. Who will be doing this? Generally, nobody actually sell the covered puts, but generally people do the uncovered puts. They can sell the uncovered puts. Uncovered means you don't have the stock, you have the money, and current price of the stock is let's say current price of the stock is $118, and you're selling the put for $100. It means you are expecting the stock will come down to $100. You are already getting premium if stock goes down to $100, then at $100 you are ready to buy the stocks. So the stock will be assigned to you. You don't need to take any action. The other guy will assign that to you. When you sell the option, the other guy has the right to sell to you, and you have the obligation to accept that sell. So this is in the put option. Sell the covered puts. Generally, nobody actually do that, because if you are selling the covered puts, it means you want to sell the stock at a lower price. But if you are bullish, you are confident that the stock will not go down but go up, then you can do the covered puts. So covered put means if you are selling the put option at lower price than what you bought. So you can keep some profit on that. So for example, you have the 100 stocks at $100 each. You sell the covered put for a strike price of 100. And you get the premium of $50. At expiry date, the stock goes to 90, then you keep the premium and contract will be closed. Because it should have gone up. And if price goes to 120, then buyer may take your stock at 120. You will be selling at a higher price, and then the other guy will be making money on that. So this is the covered put. But sorry, I have to see the. Can you explain the poor man's covered call? What does it mean, poor man's covered call? There is another question I have. Can you explain the difference between the regular calls? And I think I have responded this, Eric. What is the risk and benefit? If you have further question on that, please type in here. I will respond, but I think I have already explained this difference between the call, a regular call option, and the covered call option. So uncovered calls, you can sell the uncovered call when you are bearish. You are thinking the stock will not go higher, but you are selling the uncovered calls at a higher price because you are thinking that it will not go to that higher. If stock does not touch 118, then you are safe. So you can keep the premium, you can stay out. But if the risk is, if stock goes to 130, 140, 150, then you still have to buy the stock at the current market, which is the current price, let's say 135. You have to buy at 135 the stock, and you have to sell at 118. So I repeat, in this trade, sell uncovered calls. You don't have the stock, but you are expecting the stock will go down, and you are taking a risk. You're taking a risk, and you are selling the uncovered calls. And if stock goes above, there are no limits. I have seen few stock went from $10 to $150 in one day. So that's very, very risky. So if you are actually selling your uncovered call at 110, you get the premium of $4 per stock. But if stock goes to 140, then you have to buy the stock at 140 at current price, and you have to sell this guy at 118. Why you have to buy at 140? Because you don't have the stock, but you committed that you will sell the stock to someone at 118. So how would you do that? You have to buy the stock from the market, and you will be spending the amount at current price, which is $140, and then you will be selling to that guy for 118. So you will be making an upfront loss of maybe $2,000, $3,000, or $4,000. So this is very, very risky. And sometimes the banks and institute will not allow to do that trade. They will reject your trade because they don't want to take you a big risk on that. So next is uh, sell to open uncovered puts. So this is just a reverse. You can buy the Apple price at a lower price. You sell the uncovered puts at a strike price of generally that you can do if you think that the stock will go higher. You can sell the puts uncovered. Bank will actually hold your money for that time frame, uh, equivalent to that much stock price. For example, you are saying that uh, the strike price is 100 and you are selling uncovered puts. One contract means $100 means multiply by 100. So bank will block your $10,000 for that trade until the expiry date or until the you close the trade. So bank will hold your money for that trade. And if stock goes bullish, stock does not come to $100 or below, and stock goes to 135, 45, so the trade will be expired and you will keep the premium whatever you get, and the trade will be expired with no action is required to do. But if stock goes to $100 or $90, then you have to buy stock for $100, even if it is $90 for current price, but someone will sell you the stock at $100. So generally, when you think that stock will go up, then you can do the uncovered puts, but your money will be blocked for that time frame. Or you can do the buy to close anytime. So these were some basic trade options for option trading. So fundamentally, if you understand, you can buy the option, you can sell the option. If you buy the option, you need to close the deal when you say close, sell to close, or buy to close. So you need to understand those terms. If you understand these and you know when, what does it mean when you actually buy the puts, what does it mean when you buy the calls, what does it mean when you buy the puts or calls uncovered or covered, then we can go to next level. So there is another poor man's covered call, the case in which one buy in the money and sell out of the money. Yeah, that is a lost trade. So next level of this is we will be discussing some key strategies. So key strategies for option trading are, one strategy is called long straddle. You can find these in the Google for more details, but I will be sharing this PDF with you guys after this webinar, and this webinar will be live on the YouTube for your future references as well. So option trading strategy. One strategy is the long straddle, which means uh, a trader will buy at the money call and at the money put when a trader will do that. So in this strategy, trader will do 2 trades at a time. So when I'm talking about the option trading strategies, so I'm already talking about 2 trades at the same time. So either you are buying and selling or call an option, but you are doing in a combination. So you are doing 2 trades at a time. This makes some strategy. So when you are buying at the money call and you are also buying at the money put. At the money means your strike price is almost same as the current price with the same expiration date and same strike price. when this strategy trader will use, when you know that stock will move, but you are not sure in which direction it will move. So it can, you have the volatility, but you're not sure in which direction a stock will move. So this is called long straddle. In the long straddle, let's take an example. STK stock trades at $100 per share, and there are puts and calls with a $100 strike price, $10 each. So I'll buy one call, which means 100 stock. So I will be paying $1,000. And at the same time, I will be paying $1,000 for the puts as well. So the total trade amount for me is $2,000. So now in this table, at the expiry date, if stock price goes to 110, my call option will become 0 for me, because I already, the premium is $10. So for me, if stock goes to 110, it will not make money for me. So for the put option, I will be negative 100, because for put option, stock should go down. So stock is going up, so I'll be losing $1,000 in the put option, but I'll be net zero for the call option, because I spent $10, I get the $10 at the strike price of 110. 120, if price goes to 120 at the expiration date, then I'll be making $1,000 more on the call option, but I'll be losing 1,000 in the put at the same time. So my net will be still 0. So get some profit. I need to see the stock at 130. So I'll be making 1,000, because my call option is working now. My put option is 0. I'll be losing that money which I spend in the put option if stock goes higher. On the other hand, if stock goes down from 100 to 10, my call option will be losing my money, but my put option will be making money, and I will be making profit if stock goes to $30, $70. So I'll start making money on that. So this is one trading option, one trading strategy when you are not sure in which direction stock will go, but you are sure that stock will go in one direction rapidly. So maximum loss you can have in this trade is $2,000 if stock stays at $100 at the expiry date. So you will be losing your put option also and your call option also, because stock is not moving. But if stock moves to plus side, so your put option will be 1,000 in loss, but your call option will give you profit. On the other hand, if it goes down, so your put option can make you money, but your call option will actually be 0 at that time. So this is the combination. This is called long straddled strategy. Now the next strategy is long strangled. Long strangled is different from the straddle. In the long strangle, you spend less money. It's the same trade. You buy the call, you buy the put, but you will go out of the money, because when you will do this, you think that stock will go up, or stock will change its position. It's very volatile. It will go in one direction rapidly, and you see it will go much higher, even more than you think. So you can go out of the money for your trades, and you can still make money. So but you are not sure in which direction it will go, bullish or bearish. You are not sure about that. So you do the long straddle. it will, the strategy covers your both ends. So if a stock goes in one direction, you still make the money, but with the risk is up to what level. So in the same example, the stock price is 100. Now you put a different strike price for call and put. In the previous example, we use the same strike price at the money, both with the same expiry date. But now we think that stock will move rapidly in one direction. So you can go, you can put, you can buy the put out of the money, when in the put option, if you are buying at a lower price, you are already out of the money. So you are out of the money for the put, you put a strike price of $90 and your premium is $5 for the puts, and you buy the call for out of the money at $110 and you are still paying the premium. So low premium when you go out of the money. So you spend $500 here for call, you spend $500 for the put. Total trade value is $1,000. And now the same thing. If stock goes to 130, you will be making money of $1,000. If stock goes to 150, you will be making more money from the call option, but your put will be expiring in loss. If stock goes lower, so as low as it can go, your profit will be increasing from put option, but your call option will be expiring. So you're trading on the both side. In which direction stock will go, you will be making money. I have a couple of questions here, I believe. Okay. How can I decide between the straddle or strangle? Yeah. So Eric, you asked this question. So as I mentioned, if you think, again, it depends on your stock analysis. If you think that stock will go upside or downside rapidly, and it will go beyond your expectation. For example, the current price is 100 and you're thinking that stock will go either 150 or it will be tanked to $50, but you're not sure because there would be earning is coming tomorrow. Let's assume the company's earning is coming tomorrow and nobody's sure which direction it will go, but you know that if earning is positive, the stock will strike to 150 rapidly, and you are sure that if earning is negative, then stock price will go to rapidly to $50. If you think this is the condition, then you can go to wrong strangled and you can spend less premium and you can buy the options at out of the money. But if you're thinking that with their earning report, stock will move, but not that much. It can go to 130, 120, and it can go to 70 or 80. Then you can go to the long straddle, which is you have a less volatility as compared to the other one. So it depends on your stock analysis. If you see the stock is more volatile, then the strangle is better strategy. But if you see the stock is less volatile, but you are not sure the direction, then you can go with the straddle. I hope I responded to your question. Okay, these are two strategies. Now let's move to this is just a chart to understand whatever I have showed in the table. So this is the chart to understand your profit and loss opportunities. So if a stock stays within 90 and 100, 110, 90, sorry, 90 is your covered call. Sorry, 90 is your put option you bought, and 110 is your call option you bought. If a stock price stays within 90 and 110, then you will be losing all your money in the premium generally. But if it goes either below 90 or above 110, then you will start making money. Okay. Is there any presentation for stock analysis? What are the strategies for stock analysis? Yes, there are some presentation I have done. If you subscribe my channel, there are few old webinars where I have done some analysis, stock analysis webinars. You can actually check that one. You can subscribe channels. I may be actually doing a stock analysis webinar in future too, where I will be talking about which indicators generally being used to see the stock direction. Okay, so long straddle. I have another question here. I will share the link in the emails. If you have registered this webinar, after the webinar, I will send you the link of my YouTube channels. Option trading strategy or stock option trading. This is one of the best strategy I love to have. When you have to buy the stock, at the same time, you can sell the covered call at the same time. So covered call money, which you get, this is the stock option strategy to trade and cover the downside of the stock by put option stock. Okay, so in this, your stock price is $50. You buy the 100 stock for $50 and you buy the puts at the same time. So you buy the puts at the same time. It means if stock goes down from 50, so you can still make money and you can keep the stock. If you buy the put option for $1 for 60 days, you are spending $100 more. So you're buying 100 stock for $5,000, and you are buying a put option and you are paying premium of 100. So total trade value is $5,100, but you are covering your loss as well. So if a stock goes down to $80, so premium you will be getting from 80 to as $30. Stock goes to $80, so you'll be making $30 profit, and you will be losing your puts premium which you have paid, which is $100. So you will still be making around $2,900 profit if you sell the stock at $80 when it goes. But if your stock goes to 20, you can your put price may go increase by $30 because the stock goes to from 50 to 30. So your put premium can also increase, so you can make money from your put option and you still can keep the stock. Vertical spread. So two vertical spreads has 6. Can you see my screen now? Okay, sorry, it was disconnected. Okay, I'm just checking some messages, text here. Wouldn't the profit or loss be the same on the for the both side? No, profit and loss may change because when you are doing the struggle and standard, it depends on the premium which you bought, and it depends on the price of the stock moving. So it can change because of your premium price. So if I go back to the viewer here, we discussed this stock option strategy. We have discussed vertical spread. In the vertical spread, there are 4 separate option trading strategy. These are all part of vertical spread. In this, you buy the call and put options, but with a different expiry dates and with a different strike price. So you cover different strategies here. So let's talk one by one. Vertical spread, bull call spread. This is called. So we have four options here, four strategies: bull call spread, we have bear call spread, we have bear put spread, we have bull put spread. So let's talk about the vertical spread, bull call spread. What you have to do, you buy a call option below the current price. It means your strike price will below the current price, and sell another call option at a higher strike price. Now recall when I said you can sell the option, either you have the stock, either you have the money, or you already have bought some option. So if you have the option, you can still sell the covered calls. So this call is called covered call. So you buy the call at a lower price and you sell the covered call at a higher price. If stock increases, if stock price goes higher, then you can make profit between the delta of your two options. So we will discuss here as an example. I think this is better. So stock price is 142 something at current price. Call options used for 40 days. You are buying the calls and selling the call. Both are call. So you are bullish on the stock. You think that stock will go higher. Keep in mind. So you buy the call option for a strike price of 135, which is below the current price, and there is no hard and fast rule. You can always change. You can I sometimes I buy the covered calls at the price, or I buy the call out of the money, which is 145 maybe. But the key is here, the strike price where you're buying the call. I'll be speaking slowly this one because this is important. When you buy a call, whatever strike price you pick, your covered call when you're selling should be higher from that strike price. This strike price you can pick and choose. To pay a less premium, you can buy the calls in the money, and you can buy the calls out of the money. That would be your call. But your call where you're buying the price, the covered call should be higher than that. That is the key on this call spread. So we are buying calls for $135. We are paying premium of 9.3, and we are selling a covered call at $150. So we are expecting that it will go. So we are getting, when you are selling, so you are getting the money. So we are getting a premium of $1.5. So net cost which we are paying for this trade is 9.3 minus 1.5, which is the total 7.7 which we paid for this trade per stock. So total maximum profit which we can get is when stock price stay below or on 150. So this will be the maximum. If stock price goes 150 and above, it means you are making the maximum profit. So after that, your covered call will be in negative. Your call you bought will be in green. So difference will always be in the net. So your net maximum profit. So you actually have a bracket of the profit. You can't do the unlimited, but you can always do some work between these. Whenever you have to do, you can sell the covered calls, you can buy the covered call back, you can sell the calls option at any time. You have free chance, but the maximum profit for the whole trade will be until stock goes above 150. So 150 stock goes, your call price is 135. So difference of this $15 minus the premium, the trade cost which you have already paid. So 15 minus 7.7 is 725. The total profit you can have maximum. The maximum loss will be your total premium you have paid. And keep in mind, you can always actually reverse your trade anytime before the expiry date at a lower loss to cover your losses. This is the bull call spread. Then there is a bear call spread. Bear call spread, when you are thinking that a stock will go up, when you believe the stock price will not increase substantially in near future, but it will still increase, but not substantially. So you sell the call option above the current price and you buy the another call option at a higher strike price. Same thing, but you buy a call option for 145, which is out of the money, and you are selling for 142. It means stock may not go too high. So you're selling the call at this level and you're buying at a higher level. So this would be the premium you have received, and you're assuming that stock will not go higher. That's why you're doing this. So you are bearish. The maximum profit you can have is the premium which you have received. And if stock stays below 142, which is your sell price of sell stock price. So if your stock stays below 142, that would be your maximum profit. And maximum loss you can have if a stock stays above 145. So whatever the premium you have paid, you will be paying this 144 minus 141, $3 difference, and the premium which you have received, that would be your loss you will be paying. That would be your maximum loss. That's how you will calculate your losses. Bear put spread. When you believe the stock price will fall, but not necessarily to the price lower than the strike price of the put that is sold. So you think that in this option, you buy the puts, you are bearish, but you are assuming that it will not go at a below certain level. So you are selling the put at $170, $50. So you are assuming that it will not go below 750. You're buying the puts at $800 strike price. This is the premium which you are paying in the money, and you're selling for 750. This is the premium which you will be receiving, and your spread cost will be around $22 in this particular example. So maximum profit you have if a stock stays below 750 or on the 750. So the difference from 780 to 750 will be $50 difference between 800 to 750. That will be your benefit minus the premium which you have paid. So this will be your total profit, and total loss will be the premium which you have paid. So this is called bear put spread. And when you do that, when you're thinking the stock will fall, but not below the lower strike price you have, which is 750. So if you are assuming that it will not fall below 750 or certain level which you think, then you can do the bear put spread as well. Now, bull put spread. When you are still bullish, when you believe that stock price will not fall significantly in the near future, so you sell the puts for in the money, out of the money. From the current price is 146, so you are selling the stock price at 145 and you are buying at 135. Both are puts, so spread will cost you, will give you $3.50 per stock, so you will be getting a premium of around $350. So that will be your maximum profit if stock stays above 145. It does not go below. As it goes below, your premium will reduce. You will be losing some money. So if it goes below 135, then that would be your maximum loss. But you already have sold the puts at 145, so you can cover your losses. So you can sell the put, means you have the right to purchase at a stock at 145, and when you buy the puts, then you can actually sell it. So this is the difference which you will be paying as a premium. So these were the key strategies, but in the option trading, you have hundreds of multiple strategies you can do. You can actually, some of the trading platform give you a ready-made trade strategy made. So when you go and do the trading strategy in one platform, and you say you want to do the bull, let's say bull call spread. When you pick the bull call spread, it will automatically give you option. When you pick the first buy, the next will be above 135. It will not give you option to buy below 135. This is the automatic system made trades strategies there. So you can use them and you can make your own strategy. And your own strategy, you can actually pick any strike price. And one more strategy, which probably I have not discussed here, which I also use. Two strategies I use the most. If I have to buy a stock at a lower price and I believe that stock will go low, so rather than just waiting that stock will come down, for example, when stock price of NIO is the EV market price, electric vehicle Chinese brand. So when stock of NIO was $53, and I thought I have to buy this, but rather than waiting, and I was assuming that a stock will come down to around 45 or 42 or 43. Rather than waiting for a stock to come at that price, I sold the uncovered puts for 43. What does it mean? If I have to buy the 100 stock at 43, I can wait for a couple of weeks. So I was saying, so rather than waiting for the NIO to come to 43, I sold the uncovered puts. So bank blocks my money for $43 strike price, which means if I sold 5 contracts, means $500, 500 stocks. So 500 stocks multiplied by 40, let's say $40. So bank blocked my $20,000 for that trade. When it comes to 43, it assigned me the stock for $43, which I wanted to buy. But at the same time, when I sold the uncovered puts, I already made a premium $3. So my cost was not around 40, it was around 37, because I already made the premium. So that is one strategy I love to do. The second strategy, when I have to buy the stock, for example, if I'm buying the stock at $45, so not only buying the stock, at the same time, I sell the covered calls. So if I'm buying a stock at 45 and I think a stock can go to around 50 or 55, so I can sell the covered call at $60. So I'll have the premium from the covered calls, and I also have the stock at 45. And if a stock goes to 60 at that time, at the expiry date, then my stock will be sold for $60. So I still have the $15 profit plus the premium which I got from the covered call which I sold at the beginning. So I also got the $3 premium from the covered calls. I also get the profit for $15. So I total profit, and my profit was $18. That's just an example. So a couple of these strategies I normally do. If I have these stocks, I used to do the covered call sell every week or 2 weeks to make money on the stock which I have. If I have the options, I bought the call option, I bought the put options. I always sell the covered calls on those options too to make some premium. But everything depends on your analysis on these stocks. So you have to have a good analysis on these stocks to do that. So when you do the analysis, then you can figure out which stock strategy, option strategy you should do. And last but not least, there are some geeks. You can explore in the Google for more details, but these are also important to understand for the option premium price changes. So Delta is one geek which you can find on the platforms as well. So Delta shows how much price, premium price and the option will change if stock price change by $1. So if one stock price is $10 and you have a premium of $1 and it goes to $11, your premium goes to $2, it means the delta is 1. So higher the delta, more the premium benefits you can get from either side. Theta. Theta is the price sensitivity on the time base. So if you have a 3-month option expiry date, so your theta will be showing you how much the premium reduction you will see every day close to the expiration date you are going. So it multiplied by the delta. So delta is the difference of the premium changes with the $1 price change in the stock, and theta is the price changes every day, which goes towards the option. It's a decay by the time. Gamma is the representative exchange rates between the option delta and the underlying asset. So gamma will show you, gamma is another geek will show you how much delta will be changing when a stock price is changing, how much sensitive that would be. That is the subderivative of delta. So delta is the price difference, but price difference will not stay same as you go close to the expiry date. So if I have an option trade for 30 days, so today the delta is $1. So if a stock price changes $1, my delta will change $1 too. If stock goes from 10 to 11, so my premium will go from 1 to 2. So that is one delta. But at the same time, the gamma is showing that there would be a $0.1 changes as you close to the expiry date. So if I goes to after 15 days, the stock price goes from 11 to 12, my premium will not change from 2 to 3, it may change from 2 to 2.5 because my delta is now being reduced as the time passes. So this will show gamma. Vega is the volatility. So how volatile the stock is. So higher the Vega, the more the volatile the stock is. So generally, if stock is Vega is higher, then your option prices are changes more frequently upside or downside, and the delta will be higher too. And there is one more is the ROHO. This measures the sensitivity of interest rate which is applied uh, to the banks. So that is the interest rate because the bank is also having some premium. So you can explore this in the Google. So I just actually shared these few geeks. There are more geeks for the option, but the key geeks which you should focus on when you are doing the option trading is delta and uh, delta and Vega, delta, theta, and Vega. These are the key geeks which I used to follow before I do the option trading. But every option trading based on the stock analysis. So if you have the good stock analysis, then your option trading strategy will also be beneficial for you. But if you don't, everything based on the stock. So if a stock actually going down or up, the option trading is going in the same direction. So your stock analysis will be the key for this option trading. So that's all I have for today. I hope I added some some value for your stock trading and option trading. If you have any questions, so I will be sharing my contact information, my YouTube channels and the email after this webinar. I will be sharing the PDF also for your reference, for future reference. This webinar will be added to the YouTube channels as well. So you can always go back to refer anything you want to check and you can always contact me. But I have few questions. If you have any question before we conclude, please do ask me. By the strategy, are not you losing potential of making money if a stock goes much higher? Which strategy? Dress, you asked me a question. By this strategy, I don't know which strategy you're talking about. If a stock goes much higher, especially for the stock that have potential to go higher. Can you repeat the new stock analysis? So what I said, when new stock was $53, I think in October or September. So I was expecting, my analysis was saying that stock will come to 45 or below 45. So I was not ready to buy the stock at 53. So rather than just waiting that stock can come down to 45 and then I will buy, I sold the uncovered put for a strike price of 45 at that time with a couple of month expiration date. So rather than just sitting and waiting, I got some premium. I got a premium of around $3 per stock. So I was planning, I don't remember exact number, but I was planning to buy, let's say $100 stocks. So I got a premium of $3 per stock, $300, which I kept. When a stock came to 45, then bank automatically assigned that to me at $45. And I kept the $3 premium and I also have the stock for $45. And once I have the stock, immediately I do the sell the covered calls. So to get more premium. What are the best trading platform? For me, I enjoy TD direct investing platform. I feel that is one of the best one. They have the advanced dashboard. They have the think and swim for US traders. But I think that is the best platform as far as I have seen. Covered strategy. Okay. So covered strategy means you sell your covered calls or covered puts. If it closed at 50, what would happen? You are saying that if I'm assuming, I repeat what I'm thinking about your question. You're saying if I have sold the covered put for $45 and stock just stays on 50, what will happen? Nothing. So stock will not be assigned to me, but I will still keep the premium, and I have the option to buy the stock from market at $50, but it will not be assigned to me. Sorry, I joined late. Will this webinar video? Yes, the webinar will be posted on the YouTube for later review, and I will be sharing the PDF of my presentation too. So, any other questions you have to share? So, otherwise we can conclude. I'll keep you guys email in my future distribution list. If you want to exclude from my distribution list, please let me know. I will not add you for any my subscription for future, but I will be adding your email for my future distribution list. If you don't want, you can unsubscribe me, but I will be sharing the presentation, and I will be sharing my YouTube links on the email after this webinar. But thank you very much for everyone for joining, for spending time. Apparently this webinar was free, but believe me, if you are spending your time, you are spending your money. So it was not free. Virtually it was free, but ideally it was not free. Thank you very much everyone for joining and spending time, and hope it helps you to understand more on the option trading. But if you have any question in future, you have my contact information. You can always approach me and you can contact me for that. Thanks. I'm just closing now. Thank you. Bye.